Hello, everyone. My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. Now, the last couple of days, we've been looking at how to take that next step in your evolution as an Elliottian and not only learn how to utilize the wave principle to come up with a high confidence forecast, but also, too, again, in your learning, how to capitalize on these Elliott wave patterns by understanding, or at least taking some suggestion on what would be, say, appropriate entry techniques and also, too, initial protective stop techniques. Now, we first looked at the impulse wave. We talked about that on Tuesday. Yesterday, we looked at the ending diagonal. Well, today we're going to continue our discussion by examining how to trade or how to take advantage of a three-wave decline, specifically the zigzag, and that's this pattern in the bottom left-hand corner. Now, remember, a zigzag is a three-wave move, tends to be contained by parallel lines, and the notation that an Elliottian would use to identify this structure, if they didn't call it a zigzag, they would call it a 5-3-5 formation. And the reason why is because wave A subdivides into 5 waves, wave B subdivides into 3 waves, and wave C unfolds in 5 waves as well. So just like in the diagonal, and as I discussed yesterday, there's more than one way to enter a trade. And also, too, what's probably most important about that statement is from my experience, there's not a single best way. Okay? Because again, I can remember back early on in my trading career where I was always looking for the best technique, the best entry techniques, the best, once a trade is on, how to manage that trade. What's the best technique? And ultimately, in my research and talking to many successful traders, some quite successful, hedge fund traders, that sort of thing, retail traders, people who have been doing this for 40 and 50 years, I basically came to the realization that there's not a single best way to enter a trade, exit a trade, manage a trade, identify a trade setup. Ultimately, what you're going to have to do is figure out what works best for you and what time you have to apply to the markets, your risk tolerance level, your account size. There's so many different, say, variables that must be considered because, in other words, one size doesn't fit all in this business. You have to find what works best for you. So what we're going to be looking at next is I'm going to offer, again, these are guidelines, these are not rules. I'm going to offer different suggestions on entry technique, again, based on your, say, level of risk tolerance. So the first technique would be this one right here. And again, I mention and talk about this all in my book, The Visual Guide to Elliott Wave Trading, written by Wayne Gorman and myself. So the first technique, again, is more, I never pick bottoms, okay? I don't pick tops, I don't pick bottoms. I always like to see a little bit of confirming price action. I want to see some data occur on the price chart that supports my original hypothesis about a market. So, for example, in this instance here, if we have the zigzag, and I've had this debate before with many practiced Elliottians and many veteran traders, whenever you come down in A, up in B, and you can count 1, 2, 3, 4, 5, a lot of people are like, hey, I can count 5 waves down and within wave C, let's go ahead and buy the market. Okay, again, that's not a technique that I feel good about. It's not my style of trading by any means. I want to see some confirming price action. I want to see something that begins to support my assessment. So just being able to count 5 waves down and done, I've learned a long, long time ago, doesn't necessarily mean anything. Remember, price is the only thing that can confirm an Elliott wave count. So the only way you know that you have 5 waves down and done is that prices will then rally. Okay, so you need to wait for that then rally portion of the equation before you can confidently identify, yes, we do indeed have 5 waves down and done. So this technique here is based on the idea that once prices begin to close above the extreme of wave 4 of C, then you can green light, and when I say green light, give yourself permission to begin looking for an entry. You can actually, if you'd like, go ahead and say, once we get above there on a closing basis, that wave 4 extreme of wave C, go ahead and hit the market. Take a position at that point. Your initial protective stop, of course, is going to be just a little bit below the wave C low. I always give it a few ticks, pips, satoshis, whatever. I always like to give it just a little bit of wiggle room. I don't want to offer, say, a too attractive protective stop to kind of avoid stop running, so to speak. So rather than putting it, say, for example, if wave C ended precisely at 1750 over here to the right, I wouldn't put my stop right at 1750. I might do like 1749 or 1748.5, that sort of thing. But once we take out that wave 4 extreme within wave C, and that move up is an impulsive structure, then I say, okay, yes, I now have permission to either take a position or maybe wait a few hours and then take a position, but I've now, the chains are off. I can begin to do something. And again, your initial protective stop. Now, this approach, again, is a little bit on the, aggressive side of trading, but you can see how well you're limiting your risk. And really, again, successful trading, being that consistently successful trader who's not doing this just this year, but has that intention to want to do this 3 years from now, 4 years from now, 5 years from now, you'll learn very quickly that it all comes down to being able to manage and mitigate risk effectively. Now, here's another technique, which is not as aggressive. It's a little bit more conservative, and that would be to simply draw that trend line that I call a corrective price channel and look for prices to move above the upper boundary line of the corrective price channel. So this would be a trend line break. And again, I'm focusing on closing price action, not intraday price action. I don't want to see a spike above that level. I want to see a close above that trend line. And if I see that, then I got a green light. Okay, that means I can begin to take a position. I can either immediately hit the market or just say, okay, hey, the next, say, bit of weakness or round of weakness I might see on a 15 or 60-minute price chart, I'll take advantage of that. But once this occurs on a closing basis, now you have a green light. Just think of yourself at a stoplight. Okay, you have red light, yellow light, and green light. Okay, red light means stop. Yellow light means caution, hold on, wait a minute, slow down. Green light means go. Okay, so once this occurs, now you have the green light to go. Now, in this instance here, again, I do recommend your protective stop being just below the extreme of wave C. Now, notice, again, this approach here is very aggressive, in my opinion, but in so doing, you have a very, very small risk. This approach here is less aggressive, but under this approach, you're actually assuming more risk. Okay. Now, another approach here, and I talk about this specifically in my book, is simply to wait for the wave B extreme to give way, but also too, this advance must develop in 5 waves. So now we're beginning to see something really conservative type of entry techniques. And of course, your protective stop is the extreme of wave C. And if you have the patience, and a lot of people fail at this game of trading simply because they don't have the ability to be patient. And being patient is actually quite difficult. It takes a lot of discipline. It takes a lot of mental effort to look at a market, trade sideways for 2 and 3 weeks and do nothing. It's not easy. I've been in that situation. I've done that kind of trading, and it's excruciating sometimes because as a trader, you want to trade. And, the way our minds are wired, it's just like, hey, if we're not trading, we're not making money. Well, sometimes the best trade is to not do anything, and that requires patience. So here, let me show you another technique that is kind of based on that patience concept, where you're looking for, you can count your A, B, C to the downside. You're done. Then you look for your initial 5-wave move up, and then you look for your first 3-wave decline. And then once you take out that small wave B extreme, then you can take your entry here with your protective stop. So now, look what happens when you wait. Okay, so going back to our very aggressive approach, which would be, okay, I can count 5 waves down and done. You're looking for a very small wave of equal or greater weight in the opposing direction. You pull the trigger. Here's your protective stop. You see what your risk is. Very, very small. Okay. Look what happens by being patient. Well, now you have additional data to support your assessment. And if you wait for this wave B of, say, 2, ideally wave 2 extreme to give way, now by being patient, you have more data to support your assessment, more data to support, yes, I need to take a buy-side trade, and now you're back to being able to limit risk by being patient. So it kind of comes full circle. Don't ever be in a rush to take a trade. Don't feel like you're going to miss a trade by, I got to get in here or I'm going to miss the opportunity. as you can see in these slides here, as far as entry technique, there is always going to be more opportunity, and there's plenty of opportunity, again, based on what your risk tolerance actually is. Well, that's about it for me for today. As always, thank you very, very much, and I will see you next week, and we'll go over entry techniques for the flat correction.